A single, almost invisible software glitch sent global financial markets into a terrifying nosedive, evaporating over $1 trillion in just 3 bewildering minutes. This wasn't a bank run or a geopolitical crisis, but an unholy combination of code, speed, and unintended consequences that proved how fragile our interconnected world truly is. Imagine the trading floors of the late 2000s, transformed from shouting humans to silent, blinking server farms. Algorithms, not people, were buying and selling millions of shares in milliseconds, driving the market at speeds unimaginable a decade prior. This era of high-frequency trading, or HFT, promised efficiency and liquidity, but it also built a vast, intricate web where a single thread pulled in the wrong place could unravel everything. These systems operated with such autonomy and speed that human oversight was often reduced to watching the disaster unfold in real time, helpless. The stage was set on May 6, 2010, just after 2:30 p.m. Eastern Time. A large institutional seller, a Kansas-based mutual fund named Waddell & Reed, initiated a programmatic sell order for 75,000 E-mini S&P 500 futures contracts. This wasn't unusual in itself, but the asterisk way the order was executed was crucial. Their algorithm was designed to sell without affecting price, but it was set to react to a minimum volume threshold, essentially chasing liquidity. It was a perfectly rational instruction in isolation, yet it overlooked the cascading implications. Suddenly, those seemingly innocuous sell orders began hitting a market already on edge. High-frequency trading algorithms, designed to profit from tiny price discrepancies, interpreted this sustained selling pressure not as a single large order, but as a genuine, widespread panic. What happens when every automatic system believes the sky is falling? They start selling too, amplifying the initial downturn. It was a feedback loop, a digital stampede where no one was in charge. Screens across the financial world lit up in frantic red. Prices for major stocks, household names, plunged to impossible lows. Procter & Gamble, a stable blue chip, dropped nearly 37% in minutes. Accenture, a global consulting firm, briefly traded at a single penny a share. This wasn't a slow decline, it was a vertical collapse, so fast that human traders couldn't even process what they were seeing, let alone react. The circuit breakers, designed to halt trading during extreme volatility, failed to activate in time for many instruments, or exacerbated the problem by creating islands of illiquidity. The market was eating itself alive. Then, almost as abruptly as it began, it stopped. At 2:47 p.m., just 36 minutes after the initial sell order and after most of the damage was done in the 3-minute core crash, the market began to recover. The reasons for the rebound are still debated, but the most accepted theory points to the NYSE's intervention, canceling erroneous trades, and a general exhaustion of selling pressure. But the scar remained. It was a stark, terrifying demonstration that our increasingly complex and automated world, built on layers of code and algorithms, can turn on itself with devastating speed, all triggered by a design flaw almost too subtle to pinpoint. The FlashCrash wasn't just a blip. It was a warning that the greatest threats to our engineered systems often come from within.